I shall move on with the slides. Thank you very much for joining us. And for those of you who have attended our webinars before, the way that we operate these webinars, there will be a Q&A session at the end of the webinar, but in practice, there is a Q&A function on Teams Live. That's the little question mark bubble at the top of your screen. If you have got questions as we go along, if you use the question mark button at the top, that'll enable you to post the question, and the team who are presenting today will try and answer them as we go along. If it's something that's of relevance to a wide number of people, we'll then cover it at the end as well, just as a way of recapping. If it's something that's very specific to your circumstances, we would probably suggest that we pick it up with you directly, just so that we're not talking about what would be confidential information on the webinar itself. Thank you very much, Sam. If we can move on to the next slide. So for those of you who don't know me, I'm Alistair Wilson. I am one of the tax partners at MHA Tait Walker. My background is primarily in corporate tax, and the speakers today, our backgrounds are primarily in corporate tax. We've got a dedicated specialist team in the Northeast that focuses on corporate tax as a specialism, and the presenters today are all part of our dedicated corporation tax team. Can we move on to the next slide, Sam? And just in terms of the speakers today, there's obviously myself, there's Andrew Fitton, who is a tax director within our corporate tax team, Claire Smales, who is a senior corporate tax manager within our team, and Holly Thompson, who's our senior tax manager who heads up our R&D and tax incentives team here in the Northeast. We'll move on to the next slide, Sam. So just in terms of the agenda today, we intend to cover what are the changes for companies that were announced in the budget on the 3rd of March. We're going to cover how to optimize the benefit of those changes. What should companies be thinking about what to do? And then we'll run through some examples of the impact overall for Northeast companies. And you'll see that I use the word companies deliberately in this webinar, and we'll come on to why this is clearly focused at companies. If we can move on to the next slide, Sam. So just in terms of the budget, we're going to cover the measures in a little bit of detail so that people can understand what the benefits are and how the impact will flow through. But overall, the measures that were announced in the budget that were intended to encourage investment, they were aimed at companies, and they will provide helpful cash flow benefits for companies only. And why companies only? Well, the answer to that is because the tax increases and the funds that will be raised from the changes that were announced in the 2021 budget, the vast majority of the tax increases that were announced will impact upon companies. And so the increases in tax primarily are falling upon companies via the corporation tax system. So in the answer to the question, why have some of the measures been limited to companies only? Well, it's because the tax raises have also been limited to companies only. Some of the measures that have been announced, they replicate some of the key measures that were implemented around 2008, where they provided provided assistance to companies at the time of the financial crash. And so some of the things that the government have announced are simply replicating those. There is, however, the new super deduction. Now, the super deduction is something that is different. We'll explain why it's different, but it's primarily because it offsets some of the impact of the corporation tax going up. But the real question is whether or not the super deduction is really actually super, or if it's just something that is there to try and stop businesses from deferring expenditure. We can move on to the next slide, Sam. And just a very quick comment just in relation to what was tax day, which the government had announced about a month ago was going to occur on the 23rd of March, and which was trailed as an opportunity for the government to announce what were supposed to be some interesting tax changes that they were proposing for the future. In reality, from a tax advisor's perspective, there were lots of new consultations and reviews announced. And whilst it does set the direction of travel for tax policy, there wasn't really anything that was fundamentally different. There wasn't really anything that we weren't already expecting. It did set the direction of travel, which is digitization of the tax system, more frequent reporting, and more regular collection of tax. But there wasn't really anything that really warranted the amount of hype that had been put around tax day. So the good news is, from a corporate tax perspective, there wasn't really anything in that anybody needs to either worry about or think about in a great deal of detail. And with that introduction, I'm going to hand over to the first speaker, and that's Claire Smales.
Morning, everyone. So my name is Claire Smales. I'm one of the senior managers in the tax team, and I'm just going to talk to you a little bit about the corporation tax rates and some associated changes with that. So next slide, please, Sam. So one of the announcements was obviously that the main rate of corporation tax is going to increase from 19% up to 25% with effect from April 2023. So this is obviously quite a big jump from what we've currently been paying tax at for the last few years. The good news is, for companies that do have taxable profits less than 50,000, they will continue to just pay tax at 19%, and then there'll be a tapered rate up to 250,000, and then over and above that, you've got just flat 25%. So we're moving away from the single tax rate system that we've been used to for the last few years. Next slide, please. So as you can see, it's going back to a position that we had in the past, where we had a main rate and a small companies rate, and where your tax is very much dependent on your level of profit. So initially, it's going to take quite a big jump up to the 25%, and then after that, whether it's going to continue to increase is unclear at this time. Next slide, please. So despite the fact that the tax rate is going to be increasing from 2023, we are still quite competitive, and it is still the lowest corporation tax rate in the G7 companies, but we aren't actually far behind the next one there, so it is right at that top end. Next slide, please. So although this increased tax rate isn't going to come until April 2023, you will actually start seeing the impact of that a lot sooner than that. So if anyone's familiar with deferred tax accounting, so this is where you're looking, and this is an accounting entry, which will be reflected in your statutory accounts, which takes into account timing differences between accounts treatment and tax treatment. So one of the common ones you'll see is around fixed assets and the differences between how they're reflected in your accounts and how you can claim tax relief. Now, once the 25% rate is enacted, which will happen once the finance bill gains royal assent, which is normally around the summertime, it may be appropriate to be using that 25% rate when calculating your deferred tax provisions. So it's going to be quite a big jump if you do have quite large timing differences in your business, and it is going to make the calculations a bit more complex. Just to note though, even before that this is substantially enacted, it may be appropriate for disclosure to be included within your accounts if the difference is going to make a material impact. So it is something to be aware of, and obviously something that we'll be able to advise you through that process. Next slide, please. So when looking at what tax rate needs to be applied and looking at those lower and upper limits, they will need to be proportionally reduced for both short accounting periods and also where there are associated companies. So broadly speaking, associated companies will be ones where one company has control of another, or where both companies are under control of the same person or group of persons. So they don't necessarily have to be in a group, and that's one of the key things that we're going to need to be looking at. So when you're looking at control, there's a couple of things that you would look at. So initially, you would look at the direct rights attributable to an individual or a shareholder. So normally it would be their shareholding, although there are other tests that you need to consider. However, you may also need to look at indirect rights of a particular individual. And this is where there is substantial commercial interdependence between entities. And in those cases, you will not only have to look at the rights of that particular individual, but also the rights of any of the associates of that individual. By associates would normally mean spouses or blood relatives. So it's something to take care of, especially say if you have a husband-wife situation, one owns one business, one owns another. They may be associated depending on what they do. Next slide, please, Sam. Sorry. So just looking at the substantial commercial interdependence. So it's very much something that needs to be considered on a case-by-case basis. So it'll be very particular to the circumstances of that business. But there are three types of links that are normally looked at. So one of them is the financial interdependence, where you are looking at sort of financial support being given between businesses. Economic interdependence, where you're looking at the objectives of the business, the activities, who the customer base is, or the similarities there. And also organisational interdependence. So this is where they will share common management, common employees, premises, equipment. And what this is looking to focus on is where you have circumstances where businesses might have been artificially split between different entities for whatever reason, and where if you look at the underlying businesses, that the one is very much reliant on another, or they're both reliant on each other. So they may have both do similar activities, and you have similar customer bases. There might be loans between them where one is being financially supported by another. And these are the sorts of things that need to be thought about. Next slide, please. So in order to sort of understand how that might impact on your tax limits, we've just got an example here. So I've got three companies which are owned by David, David's father, and John in varying proportions. So we'll just say John is not an associate of David or David's father, so he's completely unconnected with them. So if there is no substantial commercial interdependence between those companies, then looking at this, both company one and company two will actually be associated with each other on the basis that David and John together as a group of persons control company one and control company two. Company three, however, would not be associated to the other two companies on the basis that David by himself controls company three. So David by himself controlling company three is not the same person or group of persons as David and John controlling company one or company two. However, if the companies are substantially commercially interdependent, you then need to start looking at the indirect holdings. So if we look at it from David, David's father will be one of his associates. So when we look at David's holding, we also need to look at his father's shareholding. And on that basis, company one, company two, and company three are all controlled by David by virtue of either his direct or indirect shareholding. And on that basis, all three companies would be associated. So when you're looking at the rates of the 50,000 and the 250,000, those would need to be proportionally reduced to take into account those three associates. Next slide, please. So these associated companies rules are also going to replace the 51% group company test that's currently in place for when we're looking at whether a company is large or very large for quarterly instalment purposes. So generally, quarterly instalments will be due if a company's taxable profits are in excess of 1.5 million. And this 1.5 million limit will be reduced with the short accounting periods, and also by dividing the number of associated companies. So currently, you just look at the 51% group companies and not associates, whereas going forward, we're going to have to start looking at the associated companies too. Now, this won't actually increase the amount of tax payable, but what it will do is it will accelerate it. So if we look at an example with 31st of December 2021 year end, if it was just paying tax on the normal payment date, which is 1 month and 9 months and 1 day after the year end, you'd be paying your tax on the 1st of October 2022. However, if you're within the instalments regime, you're going to be paying your first instalment approximately 14 months before that date. So it's bringing tax forward quite a lot. So it's going to have big cash flow implications there, and it's something to be aware of. So if we look at this in an example, next slide, please. So just looking at the same group of companies that we have there, and I've just noted on there the profits of the company. So company one, profits of 900,000, company 2, 600,000, and company 3, 50,000. So if we think first, just based on the 51% group company test, so the current rules that we're in at the moment, none of these companies have any 51% group companies, so they're just standalone entities. And on that basis, none of the companies should be within the instalments regime because all of their taxable profits are less than 1.5 million. However, once the associated companies tests come into place, we need to start looking at associates, not 51% group companies. And if they're not substantially commercially interdependent, company 1 and company 2 are associated with each other, and therefore that 1.5 million limit will be reduced down to 750,000. And on that basis, company 1 is now going to be within the instalments regime. Just if they are substantially commercially interdependent, if you can recall, all 3 companies were associated with each other, and therefore that limit reduces further to 500,000. And on that basis, company 1 and company 2 would both be within instalments. So you can see that it's quite important to understand which companies are associated with each other, because it can have an impact not only on your tax, but also when you pay your tax. And instalments do bring tax payments forward quite substantially. Next slide, please. So although these changes aren't coming in until April 2023, there is a lot of things that we would suggest that people start thinking about now. So firstly, how are the application of these associated companies rules going to impact on your business interests? You know, if you own a lot of shares directly, not within a group structure, which ones are associated with others? And therefore, are you going to have some companies which aren't currently within the quarterly instalments regime, but will once you need to start taking into account associated companies? You might also want to look at if you haven't got a group in place at the moment. So, for example, you own all your shares just directly. Would there be any benefit to having a group? So, as an example, if you have a number of profit-making businesses and you might have one company that makes losses, whether it may make accelerated losses through R&D claims, something like that. Is there a way where you can bring that into a group in order to take advantage of, say, group relief rules? That in turn could reduce your overall tax profile, but also bring your taxable profits in the profit-making entities below the limits by which you'd have to pay instalments. So it's something definitely to think about. Also, if you have had a structure that has grown over a number of years, there might be some entities that have got small bits of business in there, maybe left over from previous acquisitions. Is it appropriate to try and merge some of them together or transfer the trades out from one entity into another, just to reduce the number of associates that you have when these rules do come into play? Obviously, this is something that we'd be able to assist you with, and looking at it would be very much on a case-by-case basis, because it depends on your circumstances of your structure and also what your plans are for the future. So with that, I'm just going to pass you back to Alistair Wilson, who's just going to talk about some losses.
Thank you, Claire. Sam, if we can move on to my first slide. So in terms of, I suppose, the first major change in the budget, and this relates to the use of losses. Now, I suppose at a commercial level, what we are seeing in terms of clients at the moment, a lot of clients of ours have had they've had a difficult pandemic, but absent things like R&D claims or capital allowances claims, their businesses are quite often still profitable. However, where we're seeing that losses are being made, it tends to be in the leisure sector or the hospitality sector. So these rules that have been brought in terms of loss reliefs, certainly in certain sectors in the economy, these will become very useful, and they are modelled upon what was brought in at the time of the last financial crash. The current rules, so this is effectively prior to the budget this year, the loss carryback is that you're able to carry back into the prior period, the prior 12 months. But other than that, you can use group relief, or you can carry forward losses against future profits. And since 2017, there's been additional flexibility in terms of group relief, because you're able to carry forward and group relief in future periods to other group companies. But the starting position prior to the budget was that loss carryback was for 1 year only. If we move on to the next slide, Sam. Now, what has happened in terms of the budget, there is going to be an extension to that rule. You will be able to carry back an unlimited amount of current year trading losses back to the preceding 12 months. However, then there will be an extended relief claim where you'll be able to carry back up to a maximum of £2 million of losses per year for accounting periods ending in the period from 1st of April 2020 to 31st March 2022. Now, if you think about that, that could be December 2020 year ends. It might be, I mean, we have got some clients who are June or September year ends. So this could be something which is actually going to be relevant quite quickly. Groups will be subject to a group limit in terms of 2 million of losses that they're able to carry back for each relevant period. So this isn't, I suppose, an unlimited carryback in terms of the amount of the losses that can be carried back. There is a quirk in the legislation in that there is a threshold which is known as de minimis claims, and de minimis claims are claims which are less than £200,000 of losses per company. And if you've got a group where all the companies are only making de minimis claims, then it is possible for that group cap not to apply. And so the losses do, or the loss rules do have some detail and some quirks within them. The good news is that if your accounting period immediately or in the 2 years effectively prior, where you're able to carry back into the extended period now, you don't have to prorate the amount that you can carry back if an accounting period that you're carrying back into is shorter than 12 months. So that's the, I suppose, the headline overall in terms of loss utilization. And Sam, if I can just move on to the next slide, just in terms of visualizing it. So this is really just to give you a visual that just shows that there is an extended period that you'll be able to carry losses back into as a consequence of these changes. And so this is really just to show that compared to where the rules currently are, this is definitely a welcome development. Can we move on to the next slide, Sam? And this is really an example. And this example, it's based on looking into the future, and it's looking at a business that has made losses in 2021, 2022. It was profitable in the year up to the end of 31st March 2020 and was profitable in 2019 and 2018. Using this example, then had the organisation not been able to carry back the losses previously, you would have been looking at a reclaim of something in the order of £209,000 in terms of the cash benefit, because the losses from 2021, you would have been able to carry them back into the prior year, but the unused excess you would have carried forward. Now, as a result of these changes, the extended period would enable you to get back an extra £574,000 in that case. And so you end up in a position that the total tax reclaim moves from £209,000 up to £783,000, an additional £574,000 in this case. So that's a real cash flow benefit as a result of the changes in this example. We move forward to the next slide, Sam. However, like anything tax related, it's not straightforward. You do need to have a methodical approach to go through how to best use the losses. It's trading losses only, so excess management charges or excess non-trade loan relationship deficits don't qualify. And so this is something that in some cases may either have a lower overall benefit than might be expected, or some companies may find that they don't get any benefit at all just because of the nature of their trade. But certainly for trading losses, so hospitality sector, retail, leisure, etc., this is likely to be something which could give a quick cash flow benefit. It is, however, giving up something where there is an arbitrage in favour of the Treasury in this case, because you will be getting losses or using losses where the tax paid was at 19% in the past, whereas in the future, if the tax rate goes up to 25%, you are getting money back now where the amount that you would save in the future could be at a higher rate. So it is an arbitrage in favour of the Treasury. And That's deliberate in this case. And so if you have a group, yes, you need to plan to see how can you make the best use of the losses overall. What's the best way to get benefit from that? If we can move on to the next slide, Sam. Now, in terms of the loss carryback claims, they are required to be made in the corporation tax return. Now, that process itself, what you need to think about is it might be that you need tax returns to be, or tax returns and accounts to be prepared quickly. So it might be a reason to accelerate your processes. However, going back to that de minimis concept, so these are smaller claims. De minimis claims of £200,000 of losses or less, they can be made outside a tax return, i.e. that means you don't have to have a set of statutory accounts and a tax return to go with it. Now that may be a lot faster, and so a de minimis claim could be something that you do based on draft accounts or management accounts, and you do that in liaison with HMRC to get those de minimis claims done quickly. HMRC will be unable to process claims, however, until the finance bill achieves royal assent, which will be later on, either in the late spring or the early summer. Typically, royal assent happens in either June or July. Can move on to the next slide, please. And then just in terms of the interaction of the loss relief rules with other reliefs. So a real question, if you have a group of companies, is how do you make sure that losses are arising in the same companies as profits? Now, if you think about that, if you have a group of companies and you can only do a loss carryback into or within the same entity, so you can't effectively loss carryback and group relieve in earlier periods, you need to make sure that your losses are arising in the same companies that had historically were profitable. So work out what your current loss is. Can you do anything in terms of changing the profile of where that sits? Can you use capital allowances claims, group relief, or corporate interest restriction allocations to get profits in, for example, 2019 in the same group companies as losses are arising in, e.g. 2021? And can you time tax relief for investment via the super deduction in a manner that allows carryback of the relief in a profitable company into earlier tax paying periods? So as Holly comes on to what the super deduction is, think about where you're investing, because where you invest may enable you to create losses that you carry back into earlier periods. And at this point, I'm going to hand over to Holly.
Good morning, everybody. I'm Holly Thompson. I head up the Incentives and Reliefs team at MHA Tait Walker, and I'm going to be talking about the super deduction for capital allowances and a little bit about R&D. Next slide, please, Sam. So the super deduction, it's a new type of capital allowances which is available for companies only. It offers 130% deduction for your spend on qualifying plant and machinery that occurs between the 1st of April 2021 and the 31st of March 2023. Now, unfortunately, if you entered into a contract for that spend before the 3rd of March 2021, then that spend will be excluded from it. But otherwise, you should be looking to potentially push back expenditure until the 1st of April 2021 to make the most of that. Now, there are some exceptions to the super deduction and things that aren't qualifying plant and machinery. Those are things like used or second-hand plant machinery, cars, long life assets, and specifically special rate expenditure, which includes things like light and water systems, heating systems, ventilation, thermal insulation, things that effectively form part of your building. Now, it's worth noting that those items will qualify for 50% first year allowance. However, annual investment allowance should still be available, so we would expect that to be used in preference to the 50% first year allowance because that actually gives 100% deduction. Now, the annual investment allowance is £1 million for the rest of this calendar year, but it does drop to £200,000 from the 1st of January 2022, unless there's any changes to increase that again like they did in 2021. The 130% super deduction is uncapped, so it's in theory on an unlimited amount of expenditure. But you should note that if you've got a year end that ends after the 31st of March 2023, then the 130% rate does reduce prorated down to a minimum of 100% as long as your account period started before 31st of March 2023. So next slide, please, Sam. One of the things that we wanted to sort of highlight is that the super deduction, although there's a lot of spin and there's a lot of headlines about how exciting it is, it's actually not as exciting as it potentially sounds. It's potentially not that super. Effectively, it's a method of trying to match off the tax relief that you're going to get on your expenditure over the next 2 years with the tax cost that you would get from adding back depreciation once the tax rate goes up to 25% from 2023. So we have a little example here just to illustrate this. So we have a company that invests £750,000 on plant and machinery on the 1st of April 2021 and adopts a standard depreciation policy over 5 years. If you look at the first example, based on the current rules, they would get annual investment allowance on that investment. They would receive tax relief at 19% on the differential between the annual investment allowance and the added back depreciation. However, when the depreciation is being added back in future years, the tax cost of that would increase to 25% from 2023. And as you can see from the table, the first table, the cost of that investment would actually be £27,000 in terms of a real tax cost. Now, a lot of businesses, if they know that something's going to cost them in real terms, they potentially would delay that investment. So if you look at the table, the second table, that illustrates that the super deduction effectively brings the tax relief in line with the tax cost of adding back that depreciation in future, and it results in a tax saving instead of a tax cost. So it's a super deduction, but it's more just sensible to try and bring it in line with what the tax rate's going up to. Next slide, please, Sam. So effectively, when you're looking at trying to get the super deduction, you're probably going to want to try and invest as early as possible, because effectively if you can increase the amount of depreciation that's being added back at 19% rather than 25%, you're going to maximize those tax savings and increase the amount of tax relief that you're going to get on that rather than incurring a tax cost. Once the super deduction ends from 2023 onwards, we would expect companies to get relief in the normal way through their annual investment allowance and the writing down allowance, which might take a longer time, but it should match off with depreciation. As Alistair's mentioned, it only applies to companies because only corporation tax rates are increasing, so there's no need to have an equivalent for unincorporated businesses. One thing that we would say is because of all of the changes that are being made to corporation tax rates, losses and capital allowances, any big purchases or any big investments, really probably want to be seeking advice on the best way to structure that to make sure that you're maximising the allowances and getting the best tax relief for your business. One note on property investors, we are expecting HMRC to clarify on letting the plant. If you've got sort of communal areas in sort of student accommodation, things like that, normally you do get annual investment allowance, but the legislation specifically excludes assets for leasing, so that could be a problem for some businesses, and we are expecting HMRC to provide clarification on that specifically in relation to property investors. Next slide, please, Sam. So coming on to R&D, there's not a lot to actually announce in relation to R&D. There's nothing set in stone yet, but HMRC did announce a consultation which is taking place until the 2nd of June 2021. This comes off the back of a consultation last year and various tax cases that went through the courts. It suggested there was a justifiable need for a wider review of the two schemes. For those of you who aren't familiar, there's a scheme for smaller businesses, the SME scheme, and a scheme for large businesses or those in receipt of grant funding or subsidies, the large company scheme. And there's been a lot of attention on R&D in the press and things like that recently for potentially it being an area subject to a lot of abuse or a lot of mistakes. So HMRC have announced this really wide-ranging consultation, and they seem to be approaching it with kind of a broad brush of let's look at absolutely everything. So they're trying to review whether these two schemes are fit for purpose and whether they actually drive investment in R&D in the UK, whether they're competitive on a worldwide level, and whether they're effective at doing what they're seeking to do. So as part of that, they're going to be reviewing how the schemes operate, the differences between the two, and how they impact the innovation. They might be looking to amend the schemes, they might be looking to amend some of the definitions or introduce kind of local area-based schemes or potentially sector-based schemes. They have mentioned potentially consolidating them and getting rid of the SME scheme altogether and having RDEC for everybody with potentially different rates. They've mentioned about a departure from self-assessment as well and doing it outside of the current corporation tax system. And interestingly, they also mentioned about looking at agent fee structures and improving the quality of claims, which ties in with some of the things we've seen recently with some of our clients, some of the sort of industry commentary on potentially nefarious practices with some agents in the industry. So it will be interesting to see what comes out of that. We are intending to put a response into that, and if anybody would like to help steer how we do that, or if they have any feedback that they want to throw in there, more than happy to discuss that, so just let me know. Other than that, there's not really anything to announce yet, but watch this space. And with that, I will hand over to Andrew Fitton to talk about the rest of the changes. Thank you.
Thanks so much, Holly. So my name is Andrew Fitton. I'm Tax Director at MHA Tait Walker, specialising in large corporate tax. In terms of the changes, could I have next slide, Sam? Thanks so much. So just recapping on the changes, we've got the loss carryback, we've got the increasing tax rates, temporary super deduction, and changing definition of associates in particular. So what does that mean for North East companies, or perhaps companies in general? Next slide, Sam. Well, really, it depends. And it depends on a number of factors that each business, is unique to each business. So what that company's ownership and investor base is, and what they want, what their strategy is, what their other available tax attributes are. And just in terms of tax attributes, that's a term we use in tax, and what it means is unused losses, unclaimed reliefs, pension deficits that need to be settled in the future, but you'll get tax relief for them then, things like that. The extent to which attributes are actually valued in the accounts, liquidity of a company, recent tax profile. So these things and more, companies need to consider. And I'd just like to sort of illustrate that by a series of hopefully relatively straightforward examples. So next slide, please, Sam. Thank you. In this first example, a profitable company decides to invest £1 million of plant in the coming year, which it'll depreciate over 5 years, and it decides to take the super deduction. So it spends £1 million in the table, and it claims a deduction of £1.3 million. So its cash tax saving now is £209,000, and that's simply £1.3 million deduction, add back £200,000 of depreciation, and apply 19% to the difference of £1.1 million. So it's cash tax saving £209,000. However, from a deferred tax perspective, in its P&L account or its income statement, that company potentially has a £200,000 deferred tax charge. Now, Claire mentioned deferred tax. My colleague Claire Smells mentioned deferred tax earlier. That's an accounting concept. It doesn't result in actual cash tax in itself, but what it's there to do is look at the difference between what you've expensed or what you've put in the accounts from an accounting perspective and what the tax computations say, and where there are differences are trying to account for that. So you've got a deferred tax charge in the accounts, potentially of £200,000. And just by the way, on that, there may be additional guidance in respect to deferred tax accounting for the super deduction in due course from the accounting bodies, but we haven't seen anything yet. So just sort of bear that in mind. But it's worthwhile to say that even though you have a cash tax saving in this example, you may also have a deferred tax charge, which may negate a lot of the impact in your statutory accounts. Now, the reason I mention that is because if you're talking to people in your business, if you're talking to investors, you may say, well, we're claiming the super deduction is not great, and that's good news because it's a cash tax saving. But then, it might be worth sort of being aware that deferred tax charge could potentially come through as well. So when you look at the profit and loss account and you look at the tax charge in the profit and loss account, it doesn't look materially different to had you not claimed the deduction, because it is a question of timing. But that's not the end of the story. Could I have the next slide, please? Because as I said, every business is different, and different businesses have different tax attributes. So in this example, all the facts are the same. And in the box on the left-hand side, it's as per the example on the previous page. So our deferred tax liability, it's calculated in a little more detail there, is £200,000. And so because I've got a cash tax saving of £209,000 in corporation tax, my P&L impact in actual fact is £9,000 credit. However, contrast that to the business that previously had unrecognised tax attributes. So it had losses, but it wasn't allowed to account for deferred tax on them. Potentially, and it's very much on a case-by-case basis, potentially now I've created a large deferred tax liability in relation to the deduction, the super deduction that I've claimed. Now there might be the potential, and it's going to be on a case-by-case basis, there might be the potential to realise that that's corresponding deferred tax asset. So in actual fact, contrast the two businesses. In my in my business without any tax attributes, I recognise the tax benefit overall in my P&L account of £9,000 in this example. In my business with tax attributes that can now recognise them, I might recognise a benefit of £209,000. So quite a substantial difference, and it just depends on what the nature of each individual business is, and each business is different. Next slide, please, Sam. Take another example. A company owner's got 4 associated companies, A, B, C, and D. And of course, Claire Smales mentioned earlier, you know, the very important points around the change in the definition of associates and the impact that that can have, particularly around, you know, the rate of tax and also whether you're in the quarterly payments regime and whether tax payments are going to be accelerated. Taxable profits before capital allowances, in this example, 300,000, 500,000, 50,000 and 150,000. So in this example, because the threshold for quarterly payments, putting aside, you know, the complexities of transition years and so on and so forth, but just on a basic analysis, in this case, B is potentially in the quarterly payments regime before the super deduction. So it claims so B then says, okay, well, you know, or the company owner says, well, look, I'm going to make some investment of about £300,000 in the coming year. And a good answer would be to make that in B, because that will bring B down below my threshold for quarterly payments. So I'm still not in the quarterly payments regime. It's good news. And I don't have to pay my tax in any of these companies till 9 months after the end of the accounting period. However, but if B is buying plant and then B needs to then provide the plant to A, C and D as well for them to operate, then question, does B have a leasing trade? And if B has a leasing trade, can it actually claim the super deduction in the first place? Again, as Holly mentioned, we're waiting for more guidance from HMRC in terms of the precise operation of that. But it does sort of hopefully illustrate the fact that you know, the questions you need to answer are very specific to each business, and do need some forethought in terms of the impact that the changes have. Final example. Next slide, please, Sam. So in this example, you know, I'm looking now at the loss carryback. So in this example, the owners of Company A Limited arranged for A to make charitable donations of £50,000 and £100,000 to a charity in 2020 and 2019, respectively. There are some businesses that do that. There are some businesses that are quite altruistic, or the business owners are quite altruistic and arrange for their businesses to do that. But again, it doesn't apply to everyone. But in this example, you know, because of the impact of the pandemic, we had a loss of £1 million in the 31st of March 2021, but it had been profitable previously with profits of £400,000 in 2020 and £600,000 in 2019. So we might want to take advantage of the new carryback and say, oh, well, look, that looks good. We'll carry back to both years and eliminate the taxable profits of those companies and save some tax as a result. And we'll be able to recover £190,000 of tax. However, where we've potentially made charitable donations here, the charitable donations are deducted from profits. But if there are no profits against which the charitable donations are deductible, those charitable donation deductions are lost, and lost for good. So in actual fact, I've carried back, I've managed to recover my tax, but I've potentially lost the benefits of my charitable donations, totaling £150,000 with a cost of £28,500, which doesn't feel like a particularly sort of good answer. But nevertheless, if I needed the cash, that might be the answer I need to pursue. But again, it doesn't apply to every business, but it's something that, you know, where it does apply, it will be relevant, important matter to think about. Next slide, please, Sam. So the point I'm trying to make here is that there are lots of factors that businesses need to consider in planning what to do. Every company's circumstances are different. And I've listed out some of the factors that they may need to consider. In the examples I gave previously, I could have sort of kept going all day. I'm sure you wouldn't welcome that, and no one would. But there are a lot of different factors that businesses need to take into account. Just to name a few, do they have any losses, as we saw in example 2? What's the impact of associates, as we saw in example 3? Can we recognise deferred tax? What does my group want? You know, what do they want to achieve? What is their attitude? If I'm part of a multinational group, I might be a standalone business or standalone company in the Northeast with a local investor, owner managed. It really does depend on company by company. So if you go to the next slide, please, Sam. So what to do? I think really the best advice I can give is consider stakeholders and what will be of interest to them and what they may value. Stakeholders could be CFO and CEO, and there may be some CFOs sort of listening in at the moment. Are they most concerned with cash flow, reported results, or absolute use of cash and use of cash attributes? CFOs and CEOs may have a different view depending upon the circumstances of the owners and what the owners want to achieve, and whether those owners could be investors in a listed company because you are a subsidiary of a large multinational, or are those investors business people based in the Northeast, or is it a private equity house? So really, it's a case of, well, what do the CFO, what does the CEO want, what do the owners want? And if you have a group tax department, what might their view be? I used to be head of tax of a large group, and we weren't really concerned about cash tax because we could always access capital markets for cash. So timing of cash wasn't really such of an issue for us. What was an issue for us was how we reported and the reliability of our annual reporting, and our forecasting and how accurate our forecasting was. So in that case, I wouldn't have really had any questions to answer had I missed a cash tax saving, providing it was timing, but I would have had a lot of questions to answer if I'd got my forecasts wrong. So, again, what does group tax, what might group reporting or group tax considerations be? The point is, good quality information and forecasts are important, because poor quality information in terms of, what your tax attributes are, what your forecast profits are, what the number of associates are, what your tax profile is, what you want to achieve from organising these sort of changes in reliefs. Poor quality information will generate uncertainty and possibly poor quality decisions. So good quality information is important. And I think the other thing is early planning prior to creating or using the attributes mitigates surprises and uncertainty. So if you go back to my example on associates, if I presented that situation at the very end and company B had acquired the assets and it was leasing those to other companies to achieve or mitigate the risk of being in quarterly payments regime, then that might achieve that objective, but I might not be able to claim the super deduction, which may be a problem. So early planning and looking at it early, I think is quite important. So please do talk to us. If you think if you consider there maybe matters to consider, that you think these reliefs and these changes in tax may impact you. That's all I wanted to say on the interaction of those matters. There's just one more point I want to just come on to sort of quite briefly. Next slide, please, Sam. So just wanted to add a word on Freeports here, and all this is to say is that from a corporation tax perspective, Freeports will grant enhanced capital allowances 100% on plant and machinery for 5 years up to 2026 from the date those Freeports are sort of granted. For people investing in those Freeports, they will also grant an enhanced structures and buildings allowance at 10% straight line basis as opposed to the normal 3% for people investing in buildings on their site. That's the corporation tax impact of them. Obviously, they have other impacts as well. I appreciate, the parts of the Northeast, may have lost out on those. Other parts of the Northeast may have benefited, but obviously in the Teesside Freeport. Next slide, please, Sam. This is just to really illustrate, what it means in terms of geography, and this is a direct lift from the Tees Council website, just to illustrate. The whole area is the area of Teesside or Tees Valley. The areas marked dark blue are actually the Freeport areas. So you can see it's not one block or one area or one very large geographic zone. it's various points within Teesside that's relevant too. So I just put that out there for information. And at that, I will now pass over, I think, to Alistair.
Thank you very much, Andrew. And Sam, if we can just move on to what's effectively my summary roundup slide. So hopefully for all of you who have listened in on this webinar, hopefully you've realised that in terms of the new rules for either the loss reliefs or the super deduction and the other changes to capital allowances, this is something that's likely to give certain businesses, certain companies, a cash flow benefit, and that's either because it accelerates or increases tax relief on investment, or it creates the opportunity to do additional loss carryback claims where that can unlock cash from earlier years. So for companies in our region, I think the action list in this case is think about where tax adjusted profits and losses are likely to arise. Where will they arise either in year ends that now fall into the qualifying period for loss utilisation, or where would those fall if you were to make investments which qualify under the super deduction? Are you confident that those losses arise somewhere where they can be offset against profits, and ideally can they be carried back? If they can't be carried back at the moment in terms of an obvious way of using them, are there things that you can do with tax elections for earlier years? So can you reconfigure group relief claims? Can you reconfigure capital allowances claims? Can you do adjustments in terms of your corporate interest restriction? Can those be used as a way of getting profits into companies where you will then have losses in qualifying periods where those losses can be carried back? Bear in mind that the deferred tax impact on your balance sheet is likely to be negative going forward. Deferred tax, because it's a provision for future tax charges, that is going to have an impact in terms of what your balance sheet looks like. It may have an impact in terms of things like distributable reserves, etc. So it is something that, unfortunately, whilst it's got a cash tax impact, it does also have an impact in terms of your net assets. Try to ensure that the cash tax benefit is mirroring the deferred tax impact where possible, so that that impact in terms of your distributable profits and your net assets is minimized where possible. And don't forget about the pitfalls. Think about what your associated companies are. Think about the structure of your group. You may well have some what are effectively quasi-dormant companies where in the past you wouldn't have been concerned about the impact in terms of your overall tax cost for your group. Those companies may now have a real cost just because they're creating associated companies and are moving companies into higher rates of tax just because they exist. So there may well be some tidying up that you want to do. There may well be some strategy that you need to think about in terms of where your profits and losses sit going forward. And some of this is effectively taking us back to where we were 10 years ago in terms of the different types of things that tax advisors had to think about in terms of losses and groups and the associated companies rules. So with all of that, that's hopefully given you an overview in terms of or some of the key things that you need to think about. And Sam, our final slide was really just to see whether or not we had any questions. And at the moment, we haven't had any, which I suppose is either an indication that we've bamboozled everybody or that everybody's very happy with the content that has been covered. But unless any questions come through, I would say I think that's probably covered everything that we would like to cover. And in the absence of anything else, I would say thank you very much for attending. And if anybody does have any questions they would like to come back to us on after the event, then please feel free to do so. But in the absence of any questions, I would say thank you very much to all of the presenters and thank you all for attending.